Okay, fun seekers, now that you know how to compute the bond yields, let's turn our attention to bond yield spreads and bond valuation, bond pricing. The most exciting part of bonds, which is really not saying much. Let's get started on slide 20. The yield spreads. Spread is a fancy word, maybe not a fancy word, but that's the word we use in the investment world for the difference. Remember, we talked about the spread between the ask and the bid price back when we were discussing stock transactions? Right. So, this is the differences in interest rates that exist among various sectors of the bond market. In general, the shorter the maturity, the lower the rate. The longer the maturity, the higher the rate. And this makes a lot of sense, excuse me, because the longer the bond is till maturity, the more time there is for things to go wrong, right? And that's why we normally see higher yields for longer bonds. And of course, the higher the rating of the bond, the lower the interest rate. Just as individuals who have a very good credit score are going to pay less of an interest rate than people whose credit score is not so good. And as we said back in chapter 9, treasuries are the least riskiest, and their associated agency and treasury-backed bonds. And then munis, general obligation bonds generally have less risk than revenue bonds, although some revenue bonds are really well capitalized, meaning that the revenue is pretty steady stream of income depending on the project. And then corporate bonds being the most riskiest, giving you the highest interest rates. So here is a bond yield spread chart that you can click on. We took a look at it back in chapter 9. I think we did. I'm not sure. But there's a link on it in the chapter 9 section because we were discussing quotes for bonds. And it turns out that Fidelity has a pretty darn good website for Fidelity customers only, but they let you get some information if you're not a Fidelity client. And this is actually a pretty darn good chart. It shows you, now some of you are looking at this phone, you can't see the numbers, but it shows you the 3-month, 6-month, 9-month treasury bills, right? And then 1 year, 2 year, 10-year notes, and then up to 20-year and 30-year bonds. And you'll see that, of course, treasuries have the lowest yields, certainly now with the turmoil going on. And muni bonds are next, and then corporate bonds have the highest yields. And they show the BBB. I'm not sure if you can see it, but if you can, you'll notice that the BBB are now, whoa, 10, 8, 6%. What's going on? Well, people are worried about the recession coming. We know it's coming. We don't know how bad it's going to be. But it's not going to be pretty for some companies. And these are, remember, BBB, that's still investment grade. If they had the Bs and the BBs and the CCCs, those rates would even be higher because people have dumped those bonds thinking maybe these companies aren't going to be around. So this is part of your assignment. Well, it was part of your assignment for chapter 9 to get the spreads, the differences, and we'll discuss that in detail in this presentation as we go along. So slide 22. Often investors will speak of the bond spreads as being tight or wide. A tight spread means the interest rates among the bonds they are evaluating are very close to one another. For example, if you had a treasury paying 4.8%, a corporate bond paying 5.1%, that's fairly close, fairly tight spread. And what you'll hear people say is that's 300 basis points. No, I'm sorry, 30 basis points. 30 basis points, because each basis point is 0.01%. And I don't know why they do that. Why can't they just say it's 0.3%, 0.3% away from one another? So that'd be 30 basis points. Does that make any sense? That's what they use. They use 0.01. They call it a basis point. So this would be 30 basis points, right? 4.8 to 5.1 is 0.3. Each basis point is 0.01, so that's 30 basis points. Whereas if there's a wide difference, is what we're seeing now with some of the lower rated corporate bonds, a treasury paying 3.2 and a corporate bond paying 8.2, that's about 5%. Actually, what? Yeah, about 5%, which would be 500 basis points because each one is 0.01. For several years, bond yield spreads were very tight. During the turmoil of 2008-9, the yield spreads widened to levels not seen since the Depression, and then they narrowed significantly up until last month, when they've now widened because of people's fear that a lot of these companies, even the BBBs, even the investment grade companies, are going to be in a world of hurt. We'll see. We'll see how bad it's going to be. We know it's not going to be pretty. We know that going in. It's just a matter of how bad is it really going to be. And we've discussed this. I don't know what to tell you, folks. If you put a gun to my head, I would say, yeah, it's going to be bad, but we'll muddle through. But that doesn't mean I'm right. It could be, we know certain companies are going to disappear and they're not coming back. A lot of retail companies like Macy's and JCPenney's are going to be gone. Who knows what's going to happen to some of the restaurants? Many of the restaurant chains may survive. They might have some corporate money, but a lot of the restaurants are going to be gone. Cruise ships, who knows? A couple of airlines are probably going to disappear. So it's going to be ugly. So slide number 23. This is the effect of inflation on bond rates. And what we see, the red is the inflation, and that's much more volatile. But we see as inflation went up in the 1970s, the baby boom generation coming of age, all needing cars and jobs and refrigerators and shoes and housing. We saw the inflation going up quite a bit. And so then we see, of course, we see inflation going up, we see the bond rates going up. We see then there's when we talked about the Federal Reserve Bank breaking the back of inflation in the early 80s, causing the worst recession since the Great Depression, 1982. And we see that the inflation rate just plummeted. And as we see the inflation rate going down, we see the bonds rates going down until 2008 and 9, when we had deflation. We had prices falling. And people said, that's good, isn't it? No, not when it's your wages. And that's the biggest component of inflation, by the way, is our wages. So that's not a good thing. So you think inflation's bad, it is. Deflation's worse. And that's what they have to worry about now. Again, they had to worry about it 10, 12 years ago. And even then, people were screaming, who didn't know better, worried about inflation because we were do deficit spending. But that's Keynesian economics, and I'll leave that to your economics course. But that's when the government's supposed to spend. It's supposed to spend to prop up the economy. And we spent in there, and then we kept on spending afterwards to give tax credits to people who didn't need them. But anyway, that's politics, and poly means many, and ticks are blood-sucking insects. But we see the more inflation you have, the higher interest rate bond investors are going to demand because of inflation protection. So let us now continue with the yield curve, because as we said at the very beginning, the yield curve is a very interesting aspect of bond investing and bond analysis. Why? We're going to see. The yield curve is a graph that represents the relationship between a bond's maturity and its yield at a given point in time. So we're graphing the yield of the bond, how much the bond is paying, the interest rate, and how long it is until it matures. And so we use this to make comparison about different types of bonds. Typically, the yield curve is upward sloping. And we talked about this. Longer-term bonds have higher interest rates than shorter-term bonds. But sometimes the yield curve is inverted. It's downward sloping. That doesn't make any sense. We'll see why in a little bit. But shorter-term bond and bill rates should be higher than longer term. No, not when we have an inverted yield curve. And so here are just hypothetical yield curves. And the red one is what we normally see. We see that, short-term bond and treasury bills, and then notes, and then bonds pay less than longer term. But as we said, sometimes it does the other thing. It does an inverted yield curve. What does that say about our economy? Stick with us, boobies, because we're going to see. Okay, come on, come on, come on. All right, so now here's the yield curve. The dark one, this is actually from the New York Times, April 17th. And there's a few places where you can get them. At the Fidelity has it. Morningstar used to have, but they don't seem to have it anymore. But this is the business section of the New York Times, which is actually pretty good. They don't do stuff like Market Watch and Yahoo Finance and CNBC, but they have a lot of good stuff. I like the New York Times for that. So here's the yield curve. Short, just as we had during the Great Recession, the Federal Reserve Bank has knocked down short-term rates to almost zero. Look at that. A year ago, the 3-month was paying 2.4%. Now it's paying 0.14%. Some of you at the beginning of the semester saw the 3-month at 1.5 or something like that, 1.4, and the 6-month at 1.6 or something like that. Now the 6-month is 0.17. This is in response to the severity of the economic effects of the putting the economy into a deep freeze, putting it into a coma, self-induced coma. And so the Federal Reserve Bank has knocked down short-term interest rates to almost zero again. But if we go back a year ago, where's the year? This is 1 month ago. Here's 1 month ago. Notice that's where you guys were checking it out. It was a little over 1%. But if we go back a year ago, what we see was a slightly inverted yield curve. And when that happened a year ago at this time, people started reading in the news, and you started seeing articles and started economists talking about an upcoming recession, which is what the Republican administration does not want to hear. Any administration that's going to be up for re-election does not want to hear about an upcoming recession. But the yield curve often is an indicator of an upcoming recession. And so we'll come back to this in just a minute, but let's take a look now at some more information about the yield curve. Why do longer-term debt securities normally have higher interest rates than shorter-term debt securities? Well, why? In other words, the question is, why do we usually have an upward sloping curve? And there's a few different hypotheses, all of which make sense. The shape of the yield curve reflects investors' expectations of future interest rates. And that makes a whole lot of sense. And that sort of explains why we could have a downward sloping yield curve, because if people expect there to be a recession, then they expect interest rates to be falling. So they jump ahead and bid up the price, knocks down the interest rate. And if you didn't understand what I said, don't worry about it, because it happens as the bond market is buying and selling bonds. We said that interest rates go down, bond prices go up, but it's also the other way around. If bond prices go down, interest rates go up. So it's a two-way lever. It's pushing both ways. One pushes the other one that pushes the other one. The maturity preference hypothesis is also called the liquidity preference. Investors tend to prefer the liquidity of short-term securities and therefore require a premium to invest in long-term securities. Well, that's what we said. If you're going to lend your money out for 15 years, there's a whole lot more room for things to mess up than if you lend your money out for just a short period of time. And then the next one, why did it do that? Is the market segmentation hypothesis, which basically says supply and demand curves exist within each interest rate period. So in other words, there's a supply and demand dynamic that's going on for 3 month, for 6 month, for 2 year, for 5 year, for 10 year, for 30. And each of these makes sense. And if you didn't understand exactly everything I was throwing at you, don't worry about it. Go back and listen to it again. But just realize that it's just like stocks. It's supply and demand, but it's nowhere near as much trading as stocks, and it's nowhere near as volatile. But as people expect the interest rates to go, they will jump ahead and buy or sell the bonds to sort of get ahead of the curve. And so it's a supply and demand situation.
But each of these things makes sense, except for the time when the yield curve inverts. Then it just doesn't make any sense. You'd think you'd want the shorter term security. What factors could cause an inverted yield curve to occur? And what can the yield curve tell us about the future of the economy? Well, dear students, since World War II, every time the yield curve has inverted, when short-term rates were higher than long-term rates, the economy has fallen into recession. There was only one exception, and that was 1966, when the economy just barely touched zero, didn't go negative, but touched zero and then came back. The yield curve inverted a year ago, ever so slightly, causing renewed fears of an imminent recession, but then inverted strongly just a month ago when the virus hit. And people realized, oh yeah, no, we're going to have a recession. They were thinking, maybe not, maybe yeah, okay. Before the Great Recession, as they called it, of 2008, the yield curve was slightly inverted for 2 years. And it was such an interesting time when people were talking, we're going to have a recession. I don't know, bond ghouls, that's what they're called. They're called bond ghouls for a reason. The bond ghouls say that there's going to come a recession, but the stock market didn't believe them, right? And it wasn't until the fall of 2008 when the wheels fell off of the economy, not because of the stock market, because of the real estate market and the bonds that were tied to the mortgages, that were tied to the houses that were sold for 2 times the price they should have been, and these people couldn't afford them, and then they started defaulting, and then the bonds started defaulting, and that seized up the credit market, and of course the stock market is the canary in the coal mine. It fell down. So yeah, it got ugly. And as I said before, I think my buddy, who's a lot more aggressive investor than I am, kept saying, nah, you don't understand. We're going to have it. It's going to be terrible. Real estate's going to fall 50%. The stock market's going to get creamed. Bonds are going to get hammered. I said, Jim, it doesn't look that bad. And I was calling for the same thing that the Federal Reserve guy, Ben Bernanke, was saying, it doesn't look like it's going to be that bad. And the people I listened to, they didn't think, well, you know what? Everybody did not realize the extent to what these liar loans were doing. It was all rotten inside. Not everybody, but I mean, many other people did, like Jim. He saw it, and he said it's going to be horrible. So why are they called bond ghouls? Well, think about it. When there's a recession, what happens? Interest rates fall. Less demand for money, plus the Federal Reserve Bank typically lowers short-term interest rates. And then there's often stimulus. What happens to stocks? Right, stocks get hammered, but bonds do well. Why? When interest rates fall, bond prices go up. So that's why they're often called the bond ghouls. Now, I don't like that term. You'll hear it, and I don't think people who invest in bonds are rooting for a recession. Yeah, sure, their bond prices are going to go up, and if they intend to sell the bonds, if they're speculators, traders, then they can make a very nice, handsome capital gain. But that means new bonds. If you buy new bonds, right, the new bonds, the interest rate is going to be lower. So do you really want lower interest rates? Well, if you're a speculator, if you're a gambler, a trader, I shouldn't use the word gambling, sorry, then sure, you like that, but most of us don't, right? And I don't think most bond investors either. So forget, you'll hear bond ghouls, but it's not a nice thing to call people who are bond investors. Okay, bond price. So that was the yield curve, all right? So go back over that. If I went too quickly, I apologize, but it's it's been spot on, except for the one time in 1966. The bond market, we often talk about the stock market. Stock market gets all the press. They get all the glitter and all the glory. But the bond market is far more important, right? The bond market. There are two, you can't say one's more important than the others. But the bond market is the one to watch, and especially the yield curve. Now, bond pricing. Here it is, folks. Finally, the most exciting part of bonds. Okay, wake up. Slide number 30. Bonds are normally priced according to the present value of their future cash flows. Wait, that sounds familiar. Let's see. Semi-annual interest payments that we get every 6 months, and then the repayment of the principal at the end of the term.
Although there are other factors that will always need to be considered, such as the credit worthiness of the issuer. If an issuer runs into trouble, like right now, the price of, not yet, if we could wait a few months where everybody's waiting for the shoes to fall, the price of their outstanding bonds will fall because investors will be afraid of a default. So we're going to learn how to do bond pricing. And the bond price, according to this model, is equal to the present value of the interest income plus the present value of the repayment of the principal. Does that look familiar? It's the discounted cash flow model. So here's yet another chance for you folks who haven't learned how to do it yet. You can't leave Business 123 without knowing how to do a discounted cash flow model. It's bad for my self-esteem. We have annual compounding versus semi-annual. We're going to do annual because it's just a lot easier. The spreadsheet will do the semi-annual for us. But the difference in price is $1. It's no big deal. We take the bonds, since the bonds pay normally every 6 months, we really should use semi-annually. But annual compounding is easier to do manually, and it gives us almost exactly the same answer. And then, of course, there's a spreadsheet out there that's a presentation for you guys to take a look at that shows you how the computer does it, which is just like that. You don't have to use the present value tables, but we want you to learn how to use the present value tables. Why? Because I believe personally that it helps you with the concept. I think it does. And if some of you want to do the exponential form, God bless you. I mean, you're better than I am. I can do it if you sit down and put a gun to my head, but I don't like to do it. But some of the students in the online class, they love that exponential form. So God, I'm gonna let you do it. So here we are. Here's an example. 3M. You ever hear of them? We've talked about 3M. That's the Post-it note, folks. The Scotch tape and thousands of other products. One of the members of the Dow Jones Industrial Average, Minnesota Mining and Materials. That's what the 3M stands for. So we did this on purpose. We found a bond that was maturing in basically 10 years. Here's April 2030. And priced to yield pretty darn close to an integer, 2%, 1.958. And the reason we did that, why, is because the present value tables use years, 1, 2, 3, 4, 5, and interest rates, 2, 3, 4, 5. So that's the reason we did it. Of course, the spreadsheet doesn't care. So you can use any bond, doesn't have to be maturing in 8, 9, 10 years and have an interest rate price to yield of 2, 3, 4, 5, 6%. So if you remember the current yield, because it is on April 17th, it was selling for $1,096. It's not actually paying us the coupon rate, the nominal rate. Remember that nominal rate, coupon rate, they mean the same thing. This is a 3.05% bond that's paying us $30.50 or $15.25 twice a year. So because we had to pay $1,096, currently we're really only getting 2.782%. But it's priced to yield 1.958. Why is that? Because we're not going to get the $1,096.35 when the bond matures in 10 years. We're only going to get $1,000. So that means we're really only going to get 2% a year out of this bond. So how can we value this? How can we put a value on this bond using the discounted cash flow model? Well, just like we did with stocks, but except when we did stocks, we did the present value of the dividend payments and the present value of the expected price of the stock. Do you remember that? I sure hope so. And if you can't do that, contact me. Go on the Chapter 6 worksheets. There's Zoom recorded sessions. There's answer keys. You need to know how to do these. It's the same idea, but it's going to be a little easier. Why? Because bonds are fixed. In the case of the stocks, we really didn't know what kind of dividends we're going to get. We kind of had an idea. We saw that they've been paying dividends for the last 20 years, 30, 50, 80 years, and they've been increasing their dividend by 4% or whatever. But here, we know that unless 3M goes into default, which ain't going to happen, folks, they're going to be paying us $30.50 for the next 10 years. And then in 10 years, there's the principal payment. I mean, the interest payment. And then in 10 years, we're going to get $1,000 back, unless they go into default, which you're not going to do.
And so how can we do that? Well, we could do $30.50 times year number 1, $30.50 times year number 2, $30.50 times year number 3, and oh my goodness, what a pain in the neck that is. And that's why in chapter 10, if you've looked already, and if you haven't, that's all I'm going to show it to you, we have a combination of present value tables. The first present value table is the present value of a dollar stream of payments. So this is a new table. Over here, they don't fit on, my apologies, they don't both fit on the screen at the same time. Over here is the present value of a dollar lump sum principal. This table is the same table as chapter 6 because we were doing one-time payments, year number 1, year number 2, year number 3. But this table allows us to say, look, if we're going to get the same payment for the next 10 years, what is the present value multiplier for that stream of payments? So it was 2% for 10 years, 8.983. Okay, it's just a table lookup, folks. You price to yield 2% for 10 years maturity. So if we go back to the presentation, you'll see I took the $30.50 that we're going to get every year for the next 10 years. I then multiply it times 8.983, and that gives me $273.98. Close enough, right? Because we're going to get $305. $30.50 times 10 is $305. But we're discounting. Hopefully that word makes sense now to you. I know it's a pain in the neck, the verb we use. We're discounting that $305 back to the present using the present value multiplier. And so that $305 that we're going to get for the next 10 years is really only worth to us today $273.98. And then to that, we're going to add a one-time payment. We only get paid the $1,000 once. Wouldn't it be nice if we got it paid every year? No. We're only going to get the $1,000 once. And then, so what we do is we go back to the table and we go to the table that we used in chapter 6. 2% for 10 years, 0.820. Does that make sense? It should. Stop the presentation, go over it a few times. So if we go back to the PowerPoint, you see $1,000 times 0.820. And you could do that on your calculator, but mostly it's very easy. Just move the decimal point 3 to the right. And it turns out that we're going to get $820 today. We're going to get it today. We're going to get $1,000 in 10 years. And to us today, it's worth $820. The present value of $1,000 10 years from now at 2% is $820. You add those two up, and we believe the bond should be worth $1,093.98. Now, the quoted price was $1,096.35. That's pretty darn close, right? Well, the bond calculator gives us actually something a little higher. And why is that? Because if you look closely, it's April 15th when this thing matures. And today is what? April 22nd. I'm doing this on April 22nd. Plus, it's not quite 2%. It's a little less than 2%, 1.958. And so the spreadsheet doesn't care the fact that it's not quite 10 years and not quite 2%. The spreadsheet does the calculation for us and tells us, hey, this bond's actually worth a little bit more than $1,093. It's worth $1,098. The semi-annual payments, right, the semi-annual meaning $15.25 twice a year, gives us $1 more, $1,099, because we're getting that $15 after 6 months and then another $15 after the 12 months. So it's worth a little bit more to us. But again, they're very close to one another. They're all very close to one another. And it's A-rated, not AAA rated, so people might be taking a little bit off the price of the bond because it's only A-rated. Cool? So it turns out that bond valuation techniques are pretty reliable. Pretty reliable. What are the unknowns? The default, whether or not the company is going to have a problem or a potential for default. Companies like 3M, no, they're Dow. Every once in a while, a Dow company goes into default. GM, Kodak went into bankruptcy.
So it's just rare. But the other thing is the future of interest rates. Right. That's the one thing that is the big unknown. And can anybody predict the future of interest, the future prediction of interest rates? Turns out, no, folks. Very, very few people are actually good at it. It's like trying to predict where the stock market's going to be 6 months, a year from now. It's just it's a foolish game to even try. Although some people do, and there are people who are paid tremendous sums of money to incorrectly do it. Can you imagine how much they'd be paid if they could correctly do it? I mean, you can make all kinds of precise predictions and imprecise accurate. It'll be precisely imprecise, as Mr. What is his name? Seth Kleiman said. They're going to be precisely imprecise. Okay, so there are worksheets, 3 worksheets to go through. Do these calculations. They're not that hard once you've done them a couple times. That's why I get paid the big bucks. Contact me for help. Sit in on the face-to-face sessions on Zoom. They're recorded. Go check them out. We'll have at least one session where we'll do the worksheets together. So check us out. All right. So now let's continue. Reinvestment risk. What is reinvestment risk? Now relax. It's important for you to know this only because of it reinforces our belief that long-term investing is the best way to go. Reinvestment risk is the uncertainty about the future value of an investor's bonds investments that result from the need to reinvest bond interest payments and redemptions at yields not known in advance. So what does that mean? In other words, we're always getting our interest payments, and then we're getting our principal payments when the bond matures. And unless you're living off of this income, which some people do, some people buy the bonds to live off the income, you need to reinvest those dollars coming in. So changing interest rates don't only affect the price of your bonds, they also affect your future income as you need to reinvest the future interest in bond repayments. If interest rates have fallen, whoopee, my bond price has gone up, right? Yeah, but your income level will fall as you reinvest your income and bond repayments at lower interest rates. So people get so excited about interest rates falling. Oh boy, my bond is worth more. But guess what? New bonds are paying less. Right. Likewise, if interest rates have risen, your income level will rise as you reinvest those interest payments and those principal payments. So you see, falling interest rates are not the end of the world for bond investors if you have a long-term perspective, because you're going to be getting that income all the time, reinvesting them in the income and the bond principal payments in new bonds which are paying more interest. So again, it once again tells us in no uncertain terms that a long-term perspective is in our best interest, assuming we don't panic and don't get too greedy. The world doesn't end. If the world ends, it doesn't matter where your money is, folks. That's the truth. Duration. Now, here's some stuff that I should often take this out because it's really not something we're not going to certainly do the calculations. That is for those of us retail investors. As we're going to see, most of us buy, as we've already talked about, and as we're going to see in a bit, most of us buy our bonds through bond mutual funds. We simply don't have $25,000 or $50,000 or $100,000 lying around the house to buy just one series of bonds. So that's what the bond brokers want you to buy. This is a measure of a bond price's sensitivity to changes in interest rates and bond yields. It captures both the price and the reinvestment risk. It's used to indicate how a bond will react in different interest rate environments. So the duration of a bond changes as it approaches its maturity date and as current interest rates change. And in general, the longer the bond's maturity, the longer its duration. The higher the bond's nominal rate, the yield to maturity, the shorter its duration. The shorter the duration, the less potential price volatility and vice versa. So when we talk about short-term bond funds, intermediate-term bond funds, long-term bond funds, these are measures that those bond mutual fund managers really have to stay on top of. They don't want long-term bonds sitting in their short-term bond fund and vice versa. And then what they've created is a way to immunize. You just love it. Like we have enough virus talk as enough as it is. Investors who have a specified time horizon can use bond immunization to increase the probability of successfully achieving their desired goal. What you do is you keep the average duration of your bond investments equal to your time horizon. You would thus be more protected against interest rate induced price swings. What's the problem with this? We just don't have that kind of money, folks. Most of us don't have, several $100,000 or whatever to play with our bond portfolio. It requires constant rebalancing of your bond portfolio since durations of bonds change as interest rates change and bonds get closer to maturity. So who does this thing? Not us. Mutual fund managers, pension fund managers, they're going to learn how to do these calculations. We're not going to learn how to do them. And it's not likely that any of us are going to ever have to worry about this. So just forget about it. Next slide. But you know that's what's going on in your bond fund. If you have an intermediate term bond fund, they are doing their best to keep the duration to 3, 4, 5 years. If you have a short-term bond fund, 2 years, and then long-term 10, 20, 30 years or more. So bond investment strategies. There are 3 basic strategies. The income strategy, which is the easiest to implement. I'll answer my own question there. You buy the bonds for the interest they produce, and that's what you live off, or build your portfolio for accumulation using interest payments. Capital gain strategy is the speculation part of bond investing, trying to determine what's going to happen to future interest rates, right? Buying bonds with the hope that interest rates will fall, then selling them, then interest rates go back up again. You buy them, good luck, all I can say. And then the total return bond strategy is an idea of using both income and capital gains. And you'll see a bond fund called the such and such total return bond fund. So these people are doing income, yes, like a normal bond fund, but they're also trying to speculate or trade on the future of interest rates. And some have done well. There's a gentleman by the name of Bill Gross, and he worked for PIMCO for many years, and his total return bond fund was just awesome. He did such a good job with them, and then they sort of had a falling out. Now I think he's at Janus now, Henderson Janus. He left PIMCO, Pacific Investment Company. They're based up in Newport Beach, if you can believe it, and they're a very large mutual fund company. So check out the history of the PIMCO Total Return Bond Fund. Okay, so those are the strategies. Income strategy is being the easiest. Bond laddering. This is something, again, for the wealthy. If you have tons of money to put into bonds and you want to buy your own individual bonds, what you do is you have a ladder. It's a strategy of purchasing bonds with staggering maturities. So not only do you differentiate among bond issuers in different companies and municipalities and maybe the federal government, but you also stagger the maturities. You use diversification among maturities. Purchase some bonds with short-term maturities, some bonds with long-term maturities. Again, a very popular strategy with pension fund and mutual fund managers because they have considerable sums of money. What are the advantages and disadvantages of this strategy? Well, certainly if you're diversified, as we'll discuss in our next chapter, you are protecting yourself against things going bad in the one area that you might be concentrated in. So diversification, as we'll jokingly refer to in chapter 11, we know something is not going to make us happy. We know some part of our portfolio is not going to make us happy. So if we have a ladder, which we'll take a look on slide number 38, if we have a ladder and we have some long-term bonds and some short-term bills and notes and bonds,
then something's going to happen that's going to make us happy. Something's going to make us sad. If interest rates fall, then the long-term bonds are going to do really, really well, whereas the short-term bonds or the bills are not going to do anything, right? Because they're going to mature very soon. Whereas if interest rates rise, the long-term stuff is not going to make us happy, but the short-term stuff is going to make us happy because it didn't fall. So that's bond laddering. And again, this is from Fidelity, so check out Fidelity's great spread sheet chart of bond spreads. Cool? So go back over this. Make sure you've inculcated yourself. I love that word, inculcated. It means immersed yourself in the bond world. Because yes, bonds are boring, but they're important for ballast, for stability in our portfolios, especially if we want to be able to sleep at night well. And especially as we get older, like yours truly. But look at that. Look at that. The 5-year treasury paying 0.37, the 10-year treasury paying 0.64. I never thought I would ever live to see the day when that happened. And then look at the corporates, 4%, almost 4% for a 10-year. That's a big spread right there. Oh boy, we're in for some tough times. Look at the treasury. Who is locking in? I want to know these people. I don't know anybody, but I would like to meet somebody who just bought a 30-year bond paying 1.26%. That's ridiculous. That is just insane. Inflation is going to be at least 2% over the next 30 years, which means you're just losing money. Crazy. Well, I guess they're just so worried. They're so worried about stocks falling, real estate falling, who knows what else, oil plummeted. Where else are you going to put your money? Right. That's what they would come back and say, well, Payano, you got a better place? And I'd say, yeah. I would look at dividend-rich companies, the companies we've talked about, with their roots deep in the economy that have paid dividends. And sure, it's going to bounce up and down, maybe a lot farther down. But if the world ends, it doesn't matter where your money is. Yeah, I think I've told you that already. Now, last slide to review. We've gone through the bond calculations for bond yields. Make sure you can do that part of the worksheets. And then the pricing, make sure you can do that part of the worksheets. We've discussed the yield curve. Now, normally we would spend some time on chapter 18, preferred stock. Whoops, that was a mistake. Let's go back. Preferred stocks and convertible securities. I am going to put 3 questions on exam number 4 from that chapter. Don't bother with that chapter. Most of us are never going to be involved in preferred stocks, convertible bonds, convertible preferred. They're just not for the vast majority of us retail investors. We will spend time on asset allocation. So we're going to throw a lot at you this 1 week, this chapter and then chapter 11. But there's a prize for you, which I'll let you know in the weekly announcements. So you might have already heard it by now. So there's a little bit of a prize for you for doing both these 2 chapters in 1 week. Okay? Because these are unprecedented times, dear students, and so it's time to try some unprecedented features for you. We are so proud of you that you're still with us. It is a difficult time, obviously, but we're going to succeed. The ones that survive. See you in chapter 11 on asset allocation.